1,000 Canadian dollar after 3 months. So smart manager, they plan, right? So when they want to buy this currency after 3 months, maybe currency go up. So in this case, they can purchase call option for 3 months expiration date. Similarly, they can, like, they want to hedge payables. Similarly, they can secure target bidding. So in this case, for example, if this option is traded on exchange, then what happened? For example, exchange is only available for 50,000 Canadian dollar. One contract of call option is for $50,000. So if you need 500,000, you would be needing 10 contract of options. So that's why they say 10 call option contracts will cover the entire potential exposure. So when you heard the number of calls option contract, it means we are talking about those options, this call option that is going to be traded on exchange. It is more standardized, right? So 10 call option call option contract means one contract is equal to 50,000 Canadian dollar. So in order to build up this much amount, you need 10 contracts. So if the Canadian dollar has depreciated over time, Calais will likely let the option expire because their biggest risk is the Canadian dollar will go up. What if the Canadian dollar go down? You let that option contract to expire. You do not exercise your right to you do not want to exercise your right to purchase because purchasing from the market is cheaper. So you let that option expire. Only your loss is you pay the call premium. That's it. And also, you can use currency call options to project bidding as well. So similarly, I think we have another example. Last time we also talked, target bidding and project bidding. Similarly, if you have asked for project and your project is accepted, even then you can purchase call option to lock your rate to buy foreign currency. So let's just talk about this. So we have Morrison company, which is attempting to acquire French company and has submitted a bid in euros. Morrison has purchased call option on euro because it will need euro to purchase French company stock. The call option hedges the US firm against potential appreciation of euro, right? Because they want to purchase a French firm, they need euro. So they are worried about that when they will convert their dollars into euro will appreciate. So they buy call option. So if the acquisition does not occur, right, the spot rate of the euro remains below the strike price, Morrison let the call option expires. So what if their bidding is rejected? So they already submitted their Canadian dollar, and they can, or they already submitted the biddings for Canadian dollar. If their bidding is rejected, then and you know that the price will go down, or you bluntly say that I don't want this, I just pay the premium and that's it, or you can earn a profit as well. If the price in the euro is going down in the market, you can say that, okay, I won't buy from you, I buy from the market and let the option expire, that's it. Or I can buy from the market and pay or sell you, sorry, I will buy from the market because you are a buyer, not a seller. Good. So if the acquisition does not occur, spot rate of the euro exceed the strike price, what happened? Morrison can exercise the option and sell the euros in the spot market. If the euro price shoots up in the market, what you can do, you have a right to buy at lower price, at the option contract price. You can buy from the call seller and you will sell into the market. You can earn the profit. So alternatively, Morrison can sell the call option it is holding in either in these section, or you can have an offsetting contract as well. For example, for 3 months, which means 90 days, in 60 days you realize your option is just sorry, your bidding is rejected. So even though you have the right not to buy from this one, you enter into offsetting position as well. Here you buy the Canadian, here you buy the euro, and here you basically you sell the call option to sell the euro. So at 90 days contract you will buy euro, and on 30 days contract you will sell euro. So you can have offsetting contract, but that looks stupid because you have option to buy or not. So it's better to let it expire, right? But theoretically you can do that. Okay, now currency put options. So most of the students, they are very comfortable with understanding the call option, but it's difficult for them to understand the put option. Like I told you before, that call option is not equal to put option. These two are separate contracts. These two are different, right? In call option, if you buy call option, why I cannot write here? Let me clear all this. So in buy call option, in buy call option, for example, 0 to 30 days, one side is called buyer of call option, other side is called seller of call option. Many students, they confused. They say, okay, buy call option means here this is put option. That's it. No, these two are separate contract. If there is a call option, one side is buyer, one side is seller. Seller will receive the premium and that's it, right? Because he is giving his, he has given the buyer right to purchase from him or not. So he receive, in this case, he receive the call, that's it. Wherever the put option, it's a separate contract. So one side is buyer, one side is seller. So buyer of put option will say that I will sell you. I will sell you. In essence, put option mean right to sell. So that person who buy the put option, he is entering into a contract to sell euro, right? To sell euro to the put seller, who is essentially the buyer. Understand? So buyer of put option, basically they are seller. They expect that in future the price will go down. So they enter into a contract, and the contract is like that. I will sell you after some time the euro at 1.5 dollar after 30 days. So basically, buyer of put option is seller, and seller of put option is basically buyer, who will buy from put buyer at 1.5 dollar per euro. Understand? All in case of call option, Buyer of call option, buyer of call option is also is essentially is a buyer. Amazing, why I cannot write it here? That's, these are buyer because they want to buy after the expiration of the contract, buy the currency. But put option is opposite. They say buyer of put will sell the currency after the expiration, and the seller of put will buy from buyer of put. That is a little bit confusing statement, okay? But you need to be very careful when we are talking about put option. So most students, they cannot digest this. So put mean, amazing. So put mean right to sell, right? So that person who will buy put, basically he is seller. The person is seller and he will buy put option and he will sell the right at exercise price, at expiration to the seller of put, that you will buy from me at a strike price. That's it. So those who sell the put, they will be receiving the premium. So it means that person who is buying the currency, he will be receiving the put premium as well. So let's talk about this, explore this put option contract. Here we go. So currency put option grants the right to sell a currency at a specified strike price or exercise price within specified period of time. So if the spot rate falls, right, seller will get more money because he already entered into a contract to sell you at higher price, right? So in this scenario, in put option, the buyer of put bet that price will go down in the market. The spot rate will go down. So if the spot rate falls below the strike price, the owner of the put can exercise the right to sell at strike price. But the buyer of put will pay premium, and we will denote it with small p, those who pay the premium. So what is in the money? If spot price is less than the exercise price, we call this in the money. And if strike price is equal to the spot price or exercise, if spot price is equal to exercise price, we call this at the money. If the spot price is greater than the strike price or exercise price, we call this out of money, because we bet the price will go down, and here in the market price start go up. So this is out of money, right? Similarly, the premium depends on the difference between spot minus X, but this is a negative relationship. If spot price go up, it means the premium will be lower. The premium will decrease. If the spot price less than exercise price, the premium will go up, right? Opposite. But if there is more time period, if you are buying the put option for 30 days, its premium will be low as compared to buying the put